Copyright in these lectures is either owned by the ANU or a third party who has licensed the ANU to use it. Students may use the recording for personal study only. No lecture may be communicated online, copied or shared without the prior permission of the ANU.
That's great. Works. I'm a rock star again for an hour. Who can't sing? That's not bad. Okay, so because some wonderful person left the battery out, I have to use this. So for those listening, I'm using the microphone. That's why it sounds weird. And it's very inconvenient, and I'm already irritated. So it's a bad way to start a lecture, right? So today, a little bit different because I'm behind. So today we're supposed to have a workshop, which is very important for the second assignment, but we're going to have that next week. So for the second assignment, there's only going to be one workshop for that assignment because the ratio assignment is a lot easier than or shorter, I think is the better word, than the discounted cash flow assignment you just submitted. That's why it's worth 15%, and the DCF is worth 25% of your mark. And the lecture today should be pretty short. Hopefully I can squeeze it in an hour. Usually this is a 2-hour lecture, but a lot of these things don't really matter for JB Hi-Fi, so a lot of these ratios. So over the last 2 weeks, lecture 5 and 6 and 7 had to do with earnings. The last lecture, earnings ratios, had to do with PE, EVM, EBIT multiple ratios that are the most common in being used to value a company, including JB Hi-Fi. So for your second assignment, definitely use PE ratio and either EVM or EBIT multiple, whichever one you like, to value JB Hi-Fi as well. But like I said in my notes, I would like you to use a little bit more than just those two. Those are the two main ones. That's true. They're earnings-based. The few ratios that I'll show you today are asset-based. So what we're really doing is, what we did with the ratios is we took cash flow predictions and assumed they go on forever, reduced the whole valuation into perpetuity. So they're earnings-based ratios. We took earnings of the company, whatever company you're valuing, in our case, JB Hi-Fi, and we assumed they go on forever, and assumed a very steady state of the world, which is why we had to normalize for any abnormal items. With asset ratios, asset-based ratios that I'll show you today, what we're really doing is adding all the assets together. That's all we're really doing with a ratio analysis that is asset-based. So we're not assuming that earnings go on forever. The earnings are at steady state and they go on in perpetuity. We're just now adding up all the assets, how much to answer the question, how much they're worth, right? So a few little foundations. A company can be viewed as a collection of assets that are deployed or employed by the company to generate a revenue stream. This is the focus of the DCF approach. Assignment number 1. The company has assets, has depreciation, capital expenditure, all those issues that you tackled in assignment number 1. It also uses those assets, it uses that expenditure to buy assets and replace assets to generate a revenue stream that you had to predict and discount to time 0. That was the focus of assignment number 1. A different view, another view, is on valuation is to examine what these assets may be worth on the open market. So how much are they, if I wanted to sell the assets of JB Hi-Fi today, how much would I get for it? How much could I get for all these stores, all that inventory, all the assets that the company has on its balance sheet? And if I know the answer to that question, I know what the assets are worth, and I therefore should know what the company is worth, right? So instead of focusing on earnings, which is what assignment number 1 and EVM and PE ratio focus on, let's just focus on the assets. Now, this value may not always be, there is a relationship, but this value may not always be to the MPV, equal to your MPV of the estimate, because you may think, Joseph, aren't the assets just worth the cash flows they can generate? Yeah. Yes. Yes, they should be, theoretically. Yes, they should be equal, because if you take how much is a house worth, right? How much is a house worth is a very important question, especially these days in Australia and all over the world, in China as well. I mean, in China, real estate has become the #1 investment, just like here in Australia. And in most parts of the world, real estate, housing is the main investment in someone's portfolio. So isn't a house just worth all the rental that it can generate throughout its useful life, let's say 50 years or 80 years, discounted to time 0? Yeah, sure. Yeah. Theoretically, yes, that's the MPV. Right, so that's the whole point of assignment number 1. We generate these revenue streams forever, for 5 years, and then 10 years in phase 2, and then continuing value, discount all to time 0 to calculate the MPV. Now, I want to tell you that that's one way to do it, but another way is just to add up all the assets, right? Try to answer the question, how much are they, if I wanted to sell them today, how much would I get for it? And aren't they the same? Theoretically, yes. They should be the same. Practically, that may not be the case. Clearly there's a relationship. Asset prices and MPV of cash flows should be related and are highly related. Theoretically, they're identical. Practically, that may not be the case. Yeah. So the 3 valuations that I'll show you today are price to assets, SOTP, sum of the parts, and takeover valuation. For JB Hi-Fi, these are not the best valuation methods. For a large company, a conglomerate company that has a lot of businesses, SOTP is always the best method to use. So if we were, in this class, if we were valuing Wesfarmers, a company that has a lot of different business units, that Wesfarmers is just a collection of like 6 companies together operating in a different, and each one is in a different industry. So with conglomerates, sum of the parts is actually the best valuation method to use. JB Hi-Fi is not one of those, right? So sum of the parts, there's not any parts to sum. There's one part. I mean, the online business and JB Hi-Fi solutions are very, very small. So you can think, oh, that's a separate part. I can add up that value together with the main asset. You could, but they're so tiny, they're negligible. So there's not really multiple parts to JB Hi-Fi business, even though that's where the growth is in the company, if you ignore the artificial growth through acquisition of good guys. So let's take a look at these. None of them are complicated. Again, it's just ratios. You're multiplying numbers. It's not going to be rocket science. This is how it works. There are 2 types of these asset-backed price to book, price to asset ratios. When somebody says, analysts actually call it price to book. When they say price to book, they mean price to book value of assets. Another word for it is price to net assets. Net assets is assets minus debt. But let's have a look at it. So 2 forms of this ratio, either price divided by net book value, which is known as market to book. That's the main one by far. That's the one you see the most. When an analyst on TV or CNBC or in their report say market to book ratio of 2, this is what they're referring to. They're referring to the price per share in the numerator divided by the net book value per share in the denominator, right? And book value of the assets. The alternative is price to net tangible assets. You see this with a few companies, specifically REITs, any sort of structured finance products that that are really pass-through securities. So what I mean by that is they are a company that gets a lot of money from investors and then uses that money to make asset acquisitions such as such as huge buildings. REITs is probably the best example of that. So real estate investment trusts, they're companies, but all they did was they sold shares to get a lot of money from shareholders and use that money to buy commercial buildings and then rent them out to companies for a fee, and then investors get their dividends is huge because the company is all artificial. They don't actually manufacture anything. They don't produce anything. There's no factory. There's just one head office managing the lease contracts on all these big commercial buildings. And the dividends are huge because all the money, there's no capex, right? There's nothing to spend money on. So they pay out most of their income, like 80%, as dividends. And for those sorts of companies, NTA gets calculated instead of the book value, but it works in a similar way. Price is easy in the numerator, price per share, that's easy to look up. What about this denominator? Well, to calculate net book value, you can just take the ordinary shares divided by the number of shares. The reason why you take ordinary equity, the book value of them is because assets, remember the formula, assets equals liabilities plus owner's equity. If you put liabilities to the left-hand side, so assets minus liabilities is equal to ordinary equity. So this is just net assets. Assets minus liability is equal to ordinary equity. So this is just net assets here in the numerator of net book value. So this is assets minus liabilities here in the numerator divided by the number of shares, fully paid ordinary shares. So not preference shares, not anything like that, because this is ordinary equity. NTA works the same way, except you strip the intangibles. Some companies have large intangibles. JB Hi-Fi doesn't, so this ratio will be the same for that company. The intangibles, I mean, goodwill should not be included in that in this intangible. It's not on the balance sheet. It's an intangible asset, but it's worthless. It doesn't do anything. So what this intangibles is talking about is like brand name, licenses, these sort of intangibles. Yep. Yeah, it's a good question. So this price in the numerator is price per share for the ordinary shares, right? So therefore, this denominator has to be the book value that's being calculated based on these ordinary shares. If the company had preference shares and you wanted to calculate preference price valuation using this ratio, in the numerator here, price divided by net book value for those listening, in the numerator, you would have price per share for that preference stock. And in the denominator, what you would have here is net assets after all the ordinary equity has been subtracted. So if net assets is, let's say, 100 billion, 90+% of that will be ordinary equity. So let's say 95% of that will be ordinary equity. So 95 billion will go to the ordinary shareholders, and what's left is what goes to the preference shareholders. So you would have here, in the calculation of net book value for the preference shares, you would have assets minus liabilities, let's say 100 billion, minus all the ordinary equity, let's say 95 billion, and you're left with 5. 5 billion divided by the number of preference shares will give you the MBV for the preference shares. That number goes in here, and the numerator is the price of the preference share per share. Yeah. That's a good question, yeah. You can use, with preference shares, the reason why in this course I haven't focused on preference shares, and the reason why in textbooks you won't find preference shares valued the way I showed you how to value a company using KGW or discounted cash flow or PE/EVM, is because preference shares are like debt. They have a fixed dividend. Because they're fixed, they have less uncertainty. And when a company sells preference shares, they essentially commit to a fixed dividend. And we know what the dividend is. So all you need to do is focus on the WACC, really, because in the numerator you have all the dividend stream, which is fixed, and then the only uncertainty is really what discount rate to use to discount this known fixed dividend to times 0. And so it just becomes a question of whether the company will survive in perpetuity to pay this fixed dividend. So that's a risk question, which is captured by the discount rate. So all the uncertainty with valuing preference shares, you would never use this for preference shares because you're wasting your time. It's a lot easier to value preference shares just by looking at the fixed dividend and just focusing on calculating the correct discount rate to use. And so you would never use this. I've never seen it used for preference shares because you're wasting your time. Preference shares are a lot easier to value than ordinary shares. Ordinary shares is where the uncertainty is because they are the residual claimant. They get paid last in any profit. They get paid last in any bankruptcy. So, yeah. So the NTA here, not an issue for us with JB Hi-Fi, but if you were valuing, for example, a company with a lot of intangible assets that is not goodwill, such as Fairfax, which is a media company. With media company, their licenses are huge. Their license values are massive, billions and billions and billions and billions of dollars. And their valuation is, I don't know, it's, it changes so quickly in IT space or anything digital. It's hard to, because Fairfax mastheads is a name we have in Australia for licenses with respect to newspapers. In the past, a license to print a newspaper was worth billions of dollars. Now it's basically worthless, right? Nobody buys newspapers anymore. Everything's online. So these mastheads have gone down in value, but there's no market for them, so we cannot calculate a market value. Everything's book value based, right? So with these, when you have the example Fairfax or APN, one of these media companies here in Australia or anywhere in the world, when you go to their balance sheet and you go to the intangible section in the notes, these mastheads may be worth $150 billion book value, but in reality might be worth, maybe 10, maybe 5 billion. Not a lot at all. Just, it's really hard to come up with an accurate number for these intangibles, so we strip them out generally in any book value calculation. They're subtracted. But with JB Hi-Fi, please do this method. Use the net book value. Intangibles are not that large. Remember, they may be large to you and me. $100 million may be a large amount to you and me, but JB Hi-Fi is a $2.7 billion business. It's not that large. If you calculate MBV or MBA, you might ask yourself, well, hold on. Here I have the book value of equity. So assets minus liabilities, divide by the number of shares, that's the book price. That's the book value per share. Yeah, that's true. Book value per share, that's exactly what it is. And you're taking the market value per share divided by the book value per share to figure out the ratio. And the ratio, if it's bigger than 1, there's a premium over MBV, right? There's a premium over if it's bigger than 1, the market value of the assets is larger than the book value of the assets. And if it's large enough, it's 1.5, 1.62. So the book value is twice the amount of the market value is twice the amount of the book value of the assets. You might ask yourself, why? Right? That's important as an analyst. Why is it twice? And is it good management? Is it good financial decisions? Did the company just acquire another business? Why is it so large? If you cannot identify something, what the reason is, where the magic is happening, that the market value is twice the amount of the book value, that is a concern. I always don't like when analysts just refer to it as franchise value, right? Franchise value is just like, oh, the company's really good at deploying these assets, so if they were to sell them at book value, they would get $100 million, but on market value, because they're so good with these assets versus the competition, they can use those assets more efficiently, and therefore they're worth $200 million. So that may be the case, and you can call that franchise value, or the value of that business being able to deploy these assets more efficiently than somebody else. But always be careful with that when the book value, when the market value is multiple times larger than the book value. But if it is, there is a premium over the book value, and this additional value is usually created because the company is more efficient at deploying these assets versus the competition. So let's have a look at this example. Again, this, as I'll show you on the next slide, this sort of approach, these book values for JB Hi-Fi, a company that doesn't really updates its balance sheet, once a year, it's not the best method to use. But if you're a financial stock or a real estate investment trust, by law, you have to continuously update your book value on a continuing basis because you've got additional regulatory requirements, which I'll talk about on the next slide. But let's go to the example first to show you this ratio in action. It's not complicated. So here it is in this example. I've got example here, ABC. These are annual. The reason why I gave you data on a monthly and a weekly basis for JB Hi-Fi and all the comparable companies. The reason why this student team that I took this example from took a year is because they rightly so identified that the ratio is price per share. That's updated all the time, every single day the market's open, that's true. But the denominator is updated once a year, right? Because the book value updated once a year when the company reports its balance sheet. So why do I need it on a weekly basis or a monthly basis? Yeah, that's a good point. You don't. So you can even do this. What I would recommend is you do it on a monthly basis. Weekly it's a waste of time because the only thing that's updating is the numerator, the price per share. The denominator does not change, it's fixed. So I would do it on it's only updated every 6 months, right? Because the company reports its balance sheet every 6 months. So do this on a monthly basis. If you did it on a yearly basis, like an example, I wouldn't deduct any marks whatsoever. That makes sense to me as well. So what we have here is the company we're valuing, this example ABC, for you guys JB Hi-Fi. We've got the comparable companies here, Boral, CSR, James Hardie, all these different companies. What this team did was they took an average of, so there's only one because there's no data here, but going down the line, they took an average of the two closest competitors to ABC, and that's Boral and CSR. They did it on a yearly basis, but you don't need to do that. You only need the latest. I mean, you can do an average, of course, or an average of an average in this example. But the way this valuation works is you take the final price to book ratio that you've decided on, which is usually an average of your comparable companies. That does not include the company you're valuing. JB Hi-Fi would not be included. In this example, ABC is not included in this average of 1.07. You choose that ratio, same as PE. You choose the average of the comparable companies, usually. Could be equally weighted or weighted average, your choice. And multiply that by the book value of the company that you are valuing per share. In this case, ABC. So for you guys, JB Hi-Fi, you will have to calculate the book value, which is, again, very easy to do. It's just equity divided by the number of shares. Multiply the two numbers, and voila, end of valuation, right? It's that simple. It is not very sophisticated, but ratios aren't. You know, they are much easier to do than discounted cash flows, which is why they were so popular before computers. But the valuation is just based on some kind of an industry average price-to-book ratio multiplied by your company that you're valuing's book value per share. You can do an average of an average. I certainly encourage you to do that for price to book, sort of smooth out any kicks. So here in this example, the average is 1.64. Again, it's an annual average. Probably better to have a monthly average, but if you did annual, I wouldn't deduct any marks. I understand why you're doing it. The denominator updates. Sure, the denominator does not update. That's why annual is fine. So the average over the last sort of, 10 years, 1.64 multiplied by the same, the latest, always use that latest book value per share for your company, 1.99 in this case, and you get a value per share. Notice the difference, it is quite significant. It's a big difference. That's true. In this example, see how you go with JB Hi-Fi. You can do the same analysis that I'll talk about next week in the workshop. You can do a time series plot or see how the ratios have looked over time to see how stable they are. And if they've been very unstable, then it probably makes sense to use less data or use the more recent data. If they've been stable over time, you can use all the data to calculate your average. That's fine, or the median. Don't have to use the mean. But the last sort of step is always whatever ratio you decide, the latest, the average of other, the weighted average, the equal weighted average, the median, whatever you want, multiplied by the latest book value per share for the company that you're valuing. Yeah. Yeah. So that's it for that. Not very sophisticated, and for JB Hi-Fi, probably not the best method to use because they don't have to update their balance sheet all the time. They only have to update it every 6 months. 6 months for the semi-annual results, and then 6 months later for the final year results. But for banks and insurance companies and REITs, this actually is a very good method to use. It seems simple, and you're like, how can you value a bank, such a complicated institution, using something so simple? The reason is regulation. So while the book value of equity is an accounting measure, essentially, using the balance sheet value, it should be a reliable measure of equity in financial service firms. And financial service, not just banks, also insurance companies and real estate investment trusts, for these reasons. First of all, the assets and the liabilities on a financial service firm are often financial assets that are marked to market. They are not stale, allowing for the book value to be updated continuously. Banks have to update their balance sheet, whether you know it or not, every single week, right? And they don't report this to the investors, they report it to the regulator. It is the value, they're always focusing on making sure that that number is up to date. It's not from 1995 or something like that, some machine they bought. Banks don't buy machines. There's no factory in a bank. So they didn't buy some machine 20 years ago at $200 million that's being depreciated straight line over 10 years. It doesn't work that way. When you look at a balance sheet for a financial company, the biggest asset you see is loans that they give out, right? Their largest asset on any balance sheet of a financial institution is any money they lent. That's their asset. The largest liability is the deposits, the loans they themselves wrote. Remember, the way a bank works is they get money, they borrow money at, let's say, 2% and lend it to you at 3%. That's how they make their money. Most of the time, majority of the business for a commercial bank is they borrow large sums of money for 2%, let's say, and they lend it to you for 3.5 and make the difference. Because of that, because that's the business of a commercial bank, the loans and the deposits are the largest items. On the asset side, the loans, and on the liability side, the deposits or the loans they themselves took, the banks. So they have to be up to date because Tier 1, Tier 2 capital ratios. Banks have to follow the Basel Accord regulations, which are not accounting regulations, they're supranational regulations. Supranational means they're not country-based, they're multinational. So Basel 1, Basel 2 are the famous ones, but now I think we're in Basel 4. I think we're on Basel 4 now. So it's not examinable, I won't ask you questions on it, but banks, any bank in the world, because they're global institutions, they don't just follow the regulations of Australia. They have to follow all those regulations as well as these Basel Accords. And what those regulations basically talk about, they're complex and they're a pain to read. You can Google them and have a gaze in understanding them. Essentially, what all they're based on is how much money the bank has to hold back in a reserve given the riskiness that they're taking in the loans they're writing or the commercial lending that corporates they're lending to. And the higher the risk, the higher the riskier the loans they write, so high the riskiness of the borrower that they're lending to, the more assets they have to hold back in reserve, right? Which means that they have to report this to the regulator. They're called risk-weighted assets. They have to report a ratio of how many risk-weighted assets, and assets for them are loans, how many risk-weighted loans, and it's not just loans the total, they have to be risk-weighted. So if they're lending to a riskier person or a riskier company, they have to risk-weight that loan up and therefore hold more reserves, right? So and all the time, I think it's on a weekly basis, they have to report to the regulator Tier 1, Tier 2 I think it's now there's a tier something, I don't know what it is. But a financial crisis changed a lot of these regulations to make it stricter for banks in lending to risky individuals and companies. But what it means is these loans and these deposits have to be marked to market. They have to be up to date all the time, right? So because of that, these balance sheet items that you would say, oh, it's stale, it's old, it's old on a JB Hi-Fi balance sheet. Yeah, that's true. They're probably stale. But for a bank or an insurance company or a REIT, they will not be stale. And the second reason why you can, so those are two reasons that I combined. The other reason is banks don't have depreciation. They have no PP&E. Most of the time, if they have a PP&E, it's the building they own. That's it. There's no factory. There's no machinery. Most of their assets are either the loans, human capital, but that doesn't get reported on the balance sheet because that is impossible to quantify. So they don't have anything to depreciate. And depreciation is a big factor in determining the book value of manufacturing firms. Even for JB Hi-Fi, depreciation is not small. It's not large, but it's not small. It's not negligible. But for a bank or insurance company, it is negligible. So when you're thinking, oh, the book value of assets is inappropriate because I'm using straight line depreciation, when in reality I should be using something else to more accurately reflect the value of this this PP&E, this property, plant, and equipment. That question is a moot point, is irrelevant in a bank. So you can use this very simple price to book or market to book. Price to book means price to book, or market to book means the same thing. What market means is market price. Right? So price to book, market to book means the same thing. It's referring to this very simple ratio of price per share divided by a net book value of assets. Okay. I don't have time to look at but here it is historically what it looks like. So for you, actually I don't have time to go to, it's important, I'll find the time. So for the second assignment, data for the multiples, what you'll find is I gave you data of price to book ratios here. Price to book, market to book, same thing. For JB Hi-Fi, all the comparable companies. Once you've selected your, see, I've updated it. I'm not that lazy. Once you've selected your comparable companies, remember 3 or 4 is what we want. Take an average. Do not use that ratio, obviously. 60 price to book is crazy. Yeah, that's Amazon, I'm sure, right? Oh no, Dixon's. Amazon just as bad, 35, right? So that's insane. So please do not use stupid ratios, right? It's like using a negative beta. Again, negative price to book doesn't exist. It's just the companies, there's no such thing as negative share prices, so the book value is negative. Ouch. Bad time to be that company, right? So do not use this ratio, do not use that company, do not use this. This also looks suspect. It looks pretty high, but the other ones look reasonable to me. Yeah. That is pretty high, but that's, I suspect it was, it's been high for a while. Yeah, see, so JB Hi-Fi has been growing historically a lot. That's crazy. Even 3 is like, ooh, that's a bit high, but that's okay. It's not crazy. It's not 10 or 20 or 30 or whatever it is, but 3 is, it's not small. That means JB Hi-Fi is able to deploy its assets very efficiently so that the market price relative to the book value of those assets is 3 times. That's impressive. Right? Yeah. Okay. Next. So that's price to book, not complicated, but definitely do it for your company. Even though JB Hi-Fi is not the best candidate for this valuation, as you'll see, it's even less of a candidate for this sum of the parts business. Sum of the parts is a good valuation. It's actually a very good valuation method. It's actually, it's a mixture of earnings and asset-based valuation. So let's have a look at it. So sum of the parts, like the name implies, SOTP, is simply a sum of all the individual companies within a company. You can think of a company as a collection of assets, which is exactly what it is. But usually within a company you have small companies, right? So for a large company like, let's say, Wesfarmers, they have, Bunnings is a separate company. Coles, a separate company. The finance division of Wesfarmers, separate company. The coal division, the energy division, they're all sort of separate companies working not really together, but there's some collaboration and some overlap, but largely they're individual parts, individual assets. And those we can value separately and sum them all up. That's how sort of the valuation measure works. The reference point is what the individual assets within the company are notionally worth on the open market to be sold by their parts. So Wesfarmers was to split, and would want to sell its different parts. It would be selling Bunnings. It would be selling. It actually plans to sell Coles. They told us that. Coles is actually in the process of being sold, spun off as a separate company and listed on the exchange by Wesfarmers. Yeah. So Coles is becoming a separate company. They're not interested in it. They did very well out of Coles. They bought it for so cheap. They turned the company around, and Coles beat Woolworths. They're not number one in size, but they're number one in terms of they were not the last results, not 2018, but they were for a long time in terms of growth, store-to-store sales, like-for-like sales, all the metrics that you have for retailers, food retailers in Australia and around the world. Coles defeated Woolworths. And Woolworths made horrible decisions with Masters and Dick Smith, so they also made horrible mistakes. So it became easy to defeat them as a competitor. And Wesfarmers did all that, right? It wasn't Coles. Coles was not a separate company. It was part of Woolworths. It was part of Wesfarmers. So the company did really, really well, and they turned the company around. Now they want to sell it for a juicy premium, I suspect. Yeah. So SOTP is just it's a portfolio valuation approach where each company is a separate asset in this portfolio of a company. It is based. Each of that separate section of a company gets its own valuation that is added up. All right. Let's have a look at it. Oh, before I get to it, I've got one more slide. What does it say? So the approach is divide the assets of the company into identifiable units or segments. So in annual statements, when a company has multiple companies, they call them largely segments, and for each segment, sometimes they report different results, earnings, their balance sheet as well. So if you go to the Wesfarmers annual statement, don't go because it's scary. It's a very long document because it's a very large company. It's not JB Hi-Fi, 100 pages or something like that. It's a lot larger for Wesfarmers because it's a huge company. You will find, you go to the notes, you'll find for each unit, for Coles, for example, or Bunnings, you'll find financial information. You'll find a mini income statement and a mini balance sheet just for that segment, right? So if we have separate data for that, we can use that and use the ratios I've talked about, PE, EVM, to value those. If sometimes these large companies will have their separate companies listed, not really in Australia, in the US. So you as a company are listed on an exchange, and a company you own is also listed, right? So in the US that's common because US is 10 times bigger than Australia, so their market is much larger. But yeah, you can have a subsidiary that is publicly listed as well, traded on the exchange. So market value for that business is very easy to you don't calculate anything, you just look it up. Yeah, but most of these assets will not be listed, certainly not in Australia, such a small market compared to the US. For operating divisions, you can find for each of these separate segments, you need to find comparable companies and use their ratios to value. Right? You can apply the EVM, the P, the EBIT multiples I talked about in the lecture on Monday or in week 6 as well. If you have no information, these market values for these different segments, you can use private transaction multiples or ratios from acquisitions, that any data that you can get your hands on really that you can use as a comparable for these different segments. You can always estimate an NPV of that individual segment. You can do if you have enough data, you can do an NPV calculation of Coles, right? Just like we did for JB Hi-Fi, have a separate KGW model or whatever discounted cash flow model and discount the earnings to times 0. You can always also use just the book value, but like I said on my previous slides, sometimes that number is old, it's stale. Yeah. And you cannot, I'll show you, the debt and the non-equity claims are treated just like in a DCF, they're subtracted at the very end. So let's look at an example to give us some context here. So this is what the SOTP valuation sort of looks like. So let's have a look at it. So here we've got some company, Wesfarmers, big surprise. Australia's largest conglomerate, right? That's why I have it in an example. It's the best method to use. Sum of the parts is the best method to use for conglomerates, for conglomerate companies that have multiple businesses, right? Conglomerates are not as popular as they once were in the 80s and the 90s. The reason is specialization. We live in a world that has sort of shown that specialization is the way to create value, basically is what I'm looking for. In the 80s and the 90s, that thinking was not dominant. The thinking behind a company was diversification, right? You don't want one business, you want to spread your arm as a company in multiple industries, diversify to reduce your risk, and therefore create value for shareholders. That's true. But over the last sort of 20 years, that has changed. The thinking is more specialization. If you have one thing that you're the best at in the world as a company, focus on that. Defeat your competition and be the best. And if you can do that, it doesn't matter if it's one thing is enough. If you can be the best at something, focus on that. Focus all the resources of your company on that one thing. Beat everybody that you're competing with for market share. Get all the customers, and the market will reward you with value. So that's why conglomerates, you don't see those anymore. That's why conglomerates have kind of died in the 21st century. There's only a few large conglomerates left in Australia. Wesfarmers is the best example by far, right? Because specialization as opposed to diversification has become dominant in corporates around the world. So Wesfarmers, what do we got here? We've got a hardware division, so that's Bunnings. We've got traditional, which is your Bunnings stores, and also warehouse. Warehouse is actually the larger business. They do commercial supply as well, not just the Bunnings stores that we're all known, because we're small potatoes for Wesfarmers. But there's only 25 million customers, and they all sort of buy $10, $20 things. If you can supply to a large commercial construction site that orders, millions and millions and millions of dollars of hardware in a single transaction, you have that division as well. So we've got two divisions within this hardware division. We've got a traditional, which is Bunnings, and the warehouse division of Bunnings. We've got expected earnings of EBITDA for each of these. So for the traditional 47, for the wholesale it's 424. Each of these EBITDA will have EVM ratios, 5.7 from a comparable company. Comco multiple means comparable company multiple. 5.7 for the traditional division, 9.9 for the warehouse division. Multiply the two together, you get a valuation. All right. Just like I showed you on Monday. So it's just you have an earnings ratio. Even though it's asset-based, this valuation, SOTP is a mix of the two. For some, if you can get earnings, use earnings-based multiples. Next, for the energy division, Wesfarmers is very large in the energy space. So they have LPG, liquefied natural gas. They're huge in that. They have a EBITDA for that division for next year. Well, this is an old example, but this for you guys, if you did SOTP, this would be 2019. 105 multiplied by Comco multiple 7.8 will give you a valuation for that division. Then they have this coal division, which is massive. They are a huge company in coal mining and exploration. So that division of Wesfarmers has an EBITDA expected of this for the next financial year. Comco multiple from a comparable company, multiply the two, you get the valuation. Here it has some kind of a, it looks like a joint venture or some kind of a share of the state power. They're huge in the energy grid as well, Wesfarmers. So they have a share of EBIT. It looks like a minority share of 1.2 million. have a Comco multiple of 12.8 for them. Multiply the two, you get a valuation. Next, they have some kind of an industrial and safety valve. I don't know what that is. I wasn't following the company back in 2006. So that division is expected to earn 1.129 million. Multiplied by 7.5, you get a valuation for that. Insurance business, yes, Wesfarmers is big in insurance, actually. It's actually a financial player in insurance. That division of the company is expected to generate 138. Multiply that by Comco, you'll get a valuation. And largely, they're huge in fertilizer and petrochemicals. Yeah, Wesfarmers is a big player in that industry. Same approach. Then we've got these others that we cannot get earnings data. We don't have separate segment information in the annual statements. So usually we either, well, see what we do here. So we've got ARG. They've got a share of NPAT. So NPAT, not EBITDA, so they used a different ratio there for that. Multiply 13.5 times 14.6, you get a valuation. This forest product was actually listed, so they don't have to multiply anything. They just look up the listed price on the exchange, 145 million. Then they've got Gresham's, I don't remember what that was. And they did have a private equity fund division as well, and they had a share of some profit of 3.7 million and a Comco multiple of 11.9. And largely they had some, did I skip? Yeah. So the Gresham Partners, they had a share. And the last one, this private equity, you'll never get any data on private equity ever. So they just took the net assets from the balance sheet, 100 million. So all these different divisions have their own valuation. Their own ratios are used of the closest comparable company to that division. So not to the company overall, but to that individual division. Multiplied across, added up to get a total valuation. This is the enterprise value, the total segments. Now we add any non-operating assets, just like in DCF, 84 million. We subtract all the liabilities, which in this case is only debt, of 2.3 billion to come up with a net asset figure of 10.6 billion. Divide by the number of shares, you get a share price for the business. All right? And as you can see, even though it's asset-based, it's in the asset lecture, a lot of the multiples that I use are actually earnings-based. Earnings-based are better than asset-based ratios, because they give you the earnings potential of that division as opposed to some book value measure, right? So if you have a choice between asset-based and earnings-based ratios, always choose earnings-based. And that's why I said PE and EVM, that's what you'll see in reports. You won't see some of the parts all the time. Earnings ratios are better. They're more widely used. Analysts use them a lot more often as well. Right? So that's some of the parts. You separate the company into its individual parts, multiply, have a ratio, a P or EVM for all of these, add it all up, add all the non-operating assets, subtract all the debt or capitalize operating leases, whatever the liabilities, preference shares, minority interest, whatever the company has, to get a equity value, which is just equal to net assets. Remember, equity is equal to assets minus liabilities, so net assets just means assets minus liabilities. Divide by the number of shares and you get a share price. Before I run out of time, the last sort of method I want to show you is this takeover valuation example that I have. So this is some of the parts. I have an example for when we valued Coca-Cola in the class. The team did a sum of the parts valuation, and they actually did it based on regions as opposed to divisions of the company. You can do that. There's no rule that says you have to use it on divisions. No, you can do it based on the geographical location of that separate segment of the company. So the last thing, and here's the example. Don't do this for JB Hi-Fi. You can't anyway, there's no data. Right? The one thing you can sort of do is this takeover valuation, which is my last slide. You don't really use EPS neutral valuation. You can come talk to me in the consultation if you want to know more about EPS neutral, but again, not a good idea for JB Hi-Fi. It's not subject to a takeover. So EPS neutral is kind of stupid when the company, there's no takeover offer because you don't have any data to use. But we can do a takeover valuation with respect to to a discounted cash flow approach. So let's have a look at it. Takeover valuation, think of it as, imagine, close your eyes and imagine somebody is wants to take over JB Hi-Fi, Harvey Norman, whoever, right? Now, the likelihood of that is very low. So takeover valuations in practice by analysts are only used when there's a takeover offer made for a company. It's not actually used like we can use it in for JB Hi-Fi. Just imagine somebody takes over JB Hi-Fi. That's stupid. It's wasted time. Time of an analyst is limited at best. It's long hours, so you don't waste your time on stuff like this. But when a company, let's say Harvey Norman, comes along and wants to buy JB Hi-Fi, you would do a takeover valuation. You definitely do a takeover valuation. And you can do this in the assignment as well, even though there's no takeover